Hello, folks. Welcome to Market Trends. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. As usual, we're going to start with our disclosure. So we do this every Thursday at 2 p.m. We look at some of the ways you can understand the market and act on things in the market using TradeStation's platform. And some of the other things we're going to cover on our blog. We have some special studies that we show you guys how to include in just a second. If you want to go to tradestation.com, and along the top there's a nav bar. If you click on Insights, it will take you to our blog, and then that will also show you our the rundown we have for today. Let me just check, make sure my audio is working. It looks like everything is working well. So let me just continue. Now, you always get a little bit nervous about audio whenever you do one of these, but it looks like everything is underway. All right, so going to close that. Now, first I'm going to go over here very quickly and show you these standardized returns for some of the ETFs we're going to be talking about. We do use ETFs kind of as indicators of relative strength and things like that. So if you want to take a quick look at these. And then here, if you go to, I will show you, tradestation.com, click here on Insights, and then it will take you through to our blog. The first article there um, is called Could Sentiment Finally Turn? And that is what we will be working with. If you look at this article here, first, I want to open this one and I'll just show you. There's a lot of things here I think we've been focused on, and we've been kind of really. I think a lot of the ways that we've kind of discussed things, that, have kind of worked out, to a certain extent as we had kind of, potentially, anticipated. Last week we had kind of talked about, would the volatility shift? We had talked about, would the news cycle get better? And these things have kind of played out, kind of as some of our kind of ideas have been somewhat presented. I think the key thing to remember is that the market in some ways is always just like a pendulum. It can get really good or really bad on sentiment one way or the other in terms of where people feel about things. And in some ways, we had gotten to a point where things were highly negative, while at the same time maybe not um, being as confirmed as people think. People confuse volatility for some kind of fundamental turn in the economy, as we had talked about. That was not really panning out. Now, um, today I want to just quickly just cite a few things. First, I want to tell you, if you want to see our downloads, you can go here. It has ELD files in them, which then allows you to load indicators, which then allows you to use these workspaces. We've talked about that previously, but all the materials we have here are included in that. Also, want to tell you that our state of the market, we are now going to do this at 2 p.m. Always on Monday afternoons. That's going to be our new permanent time. So you can see this market, this chart here, and I'm going to quickly jump over to something here I thought was kind of interesting. First, going to look at this chart. Now, we had talked about this when the market crashed. This is slightly different than what we showed, but it's essentially showing the same thing. What this shows is the S&P 500's distance from its 10-day simple moving average. Now, I like the 10-day simple moving average for the S&P. I find it, kind of useful. This was the lowest level in almost 2 years at the time it happened, which means that it was just really oversold, looking at history, going back to this time in 22. But now we're also at a spot where we are like really pretty high historically. So, this is just really volatile, kind of big swings here in the market. So I think it's important to realize that everything that was kind of oversold down there is now potentially getting back a little bit to the overbought situation. Now, to me, what I'm watching is this candle on August 1st. It's a big bearish outside day. We had an inside day on the Fed. Big reversal, ugly reversal. We had mentioned at the time the fact that things could get volatile from there, and then we did break and then continue lower. But it's been pretty much, look at it. We've had higher lows every day since August 5th. So, I mean, this is interesting, but now we are in a spot where we are entering, in some ways, the quietest parts of summer. And I think it's just important to realize that, there's a spot here where this could be some resistance, this big reversal day right there. It's also near this level all the way back on July 23rd. There's some other kind of levels here that I saw there was another level. I mean, there's just, I'm not going to worry about that. But there had been this kind of level before we gapped down and the kind of selling had started. So, this part of August is in a time that is kind of known for volatility. So I think, the point here is that this big candle here could be something we want to use as a point of reference. The 10-day moving average is just starting to turn higher, but we're very far above it. So the question could be, is there a period maybe of just some kind of consolidation here at a certain point in time? Wanted to just kind of emphasize that. Now, what's interesting here is we look on MT breadth. I just noticed this, but we now have an all-time high on the advanced decline line. That's pretty interesting. We have more stocks here crossing back. The number of stocks above the 20-day moving average is crossing above the stocks above the 50-day moving average. We've noticed that before as our breadth-based sort of thing here. So I think it's interesting just to kind of realize where we stand. And now to go back to this one here. I mean, some of the levels I had kind of mentioned um, were something like, potentially 53, like kind of the lows from in here. I think, people might want to just think, if you look at this overall candle here, this range from like July 25th up through August 1st. I think we need to kind of bear this in mind now as kind of our point of reference. I had drawn a falling trend line that we've kind of broken through. And, I don't know, trend lines are, it's just, flat lines that follow exact levels, often are more reliable. So I think it's important to realize that we're kind of back up to this range. And so I think this level up here around 55.50 now is actually kind of 55.55. This level from around July 23rd, August 1st, this line across. And then people might be looking down to 5,400 roughly. So 150 point kind of period there, kind of range people might want to be drawing on the charts and thinking a little bit about. All right. So so I look at some of the things that are out there. I think it's also important to realize that we look here on our calendar, which we provide at the bottom here, is that basically through next week, we have things get, we're probably gonna have Jerome Powell on Friday, but we do have Fed minutes on Wednesday. And so I think the thing now is the market is now pricing in, a 25 basis point cut on September 18th. So, we've now kind of expressed, a lot of things. And I think it's just a question of next week, the Fed minutes. Sometimes this can be a tricky release. So, people looking for some consolidation and any kind of volatility or downside. This I think one thing we might want to keep on our calendar. But we're kind of entering a news desert here. I think Powell. Knowing him in the whole scenario. Remember, we have another CPI report before September 18th. So the thing is there any reason right now for him to show his hand? He might more be leaning a little more on the hawkish side in terms of rhetoric. We have a market that's kind of, having had a healthy bounce and it's sitting at some potential resistance. It's not necessarily to be overly bearish. I think it's also important to realize that this might be difficult, for the kind of, the situation might not be as immediately, favorable. However, I do think it's important to realize, and the big thesis I'm putting out here is that there is some really interesting stuff happening. So I'll just jump to my main point so I don't fail to cover it. This, I think, is something that we should all look at and think about. I'm going to just mention that, in my opinion, and this is more of a kind of opinion of me as someone who's covered, news and different events for many years. Someone who has also, I read a huge amount of stuff in terms of I read everything from Reuters, everything from like, most things on Market Watch, most things on these different little wires out there like Kitco and FX, all these Forex things. I try to read everything. And so I kind of see patterns they develop. And I want to emphasize that this is a real aberration that I think is not getting enough attention. Consumer sentiment has been really negative since COVID. And what's interesting, really actually since early 21 was really when it turned down. And what's interesting here is if you look at current consumer sentiment, it is as negative as 1982 when unemployment was 9%, when inflation was 6.6%. We're at the same spot on consumer sentiment. Now, if you look back to other periods of time like 1995 and 2005, the environment was not as good then as it is now in terms of unemployment and inflation. And I would also add jobless claims. I don't have the jobless claims on here, but we're also at a level here it's relatively low historically on jobless claims. And I would argue that jobless claims is not comparable because the population has gotten bigger. So in some ways, jobless claims now at 220,000 where they are is actually much more positive than they would have been in 1995 at 200,000. So the thing is that it's not a good comparison, so I didn't want to include that. But I just mentioned jobless claims and unemployment both low. So this is an environment right now where I think to really look at it, you know, there's unhappiness about people's inflation. And I think the real thing is that I don't want to talk about politics from any kind of overall view, but I think it's clear that for a lot of things, people have been unhappy with the political situation. And regardless of what you think about, Biden or Trump, I mean, the fact is neither of them had very high approval ratings relative to history of any, president. So the thing is that in many ways also reflects how people feel about the country, how people feel about the situation. So the thing is that what I'm saying is that because of COVID and because of the nature of the politics we have, or the politicians we have, just or their popularity, not even their nature, just their popularity, there has been a negativity bubble in the United States, in our society. And I think that this is something that has actually, made people less wanting to own stocks. You talk to your average person, they think we're in a recession, and so the thing is, I talk to a lot of people and I'm surprised by how little the average guy is investing right now. There's a lot of people, they don't care about the stock market. And to me, that's nuts, of course. But the thing is that there is not the kind of popular enthusiasm about the stock market as there was in the 1990s when the market was at a much higher valuation. So I think the thing is, in this, and the conditions were in some ways comparable, if not slightly worse. So the overall situation I want to mention here is there's potential, in my view, just looking at odds and history and everything else, for this number to take a swing higher. And as it does, and people start to say, I should own stocks, things aren't so bad after all. That's, I think, we have to realize is there is the potential for a significant desire for risk in the American psyche, in the overall sentiment of people. And I think that that's something that we have to realize is that the potential for that is now sitting there. And I think when you look at these numbers, it just kind of shows whatever you think about whatever. I thought people are so negative, it kind of blows my mind. I look at every number that comes out that I can find. I read like everything that comes out. I mean, I read every economic number. I look at everything. And the fact is most people don't, and people feel worse than they should. And the last thing I'll just say is in 2005, 8 through 2005, 6, 7, it was just the opposite. People felt great at the same time that houses were going underwater and the banks were way over their skis. This is the exact opposite of 2007. If you look at maybe the underlying data, we have much lower leverage levels. We have a better, job situation. All those things now are kind of the opposite. Then people were too cocky. Now they're too negative. So this, I think, is important to realize. In my view here, we could be at a spot as we move through this year toward the election and whatever that kind of does in terms of sentiment, it can unleash more positivity, I think. And as that happens, people's desire for stocks and risk appetite could improve. So that's something I wanted to lay out. I think this is very interesting to look at this comparison. So this is the main point I wanted to make today. Nonetheless, I do want to just be clear. Going back to the TradeStation platform in this study here, the S&P now is pretty overbought near term against things like the 10-day moving average or other things. I have another chart here where I look at things like RSI, which is one I've looked at a lot. Let's take a look here at what the S&P is doing versus RSI. I hadn't actually looked at that one today. I mean, it's kind of jumping back up. So, things can, we're not back to overbought yet. Look at how close we came to being oversold. So my view here is just that we have to realize that, this could be something here with some just kind of chopping this candle, this range, the August 1st range. I think that's just something we want to bear in mind. I had mentioned a pushback down to the level from August 2nd. But I think when you look at the reaction to today's price action, I had not expected something this positive. I thought we were going to have a strong retail sales report, which we did. And I thought interest rates are going to move higher, which they did. And I thought people were going to then be more negative on stocks, which they were not. So I think it's just at this point, we had this really strong momentum. There's money on the sidelines, and we're seeing it come in. And at this point, it's just like I said, this range is the one that I'm watching here. All right, so that was the main point I wanted to say about sentiment. All right, now some interesting stuff I thought was interesting here is just Starbucks is an example of some of the things happening in this market right now, where just things are bad and they turn good. Companies are fixing themselves. Kellanova, it's amazing. I didn't even know Kellogg got broken up into two companies, and now the Kellanova company got acquired. Cisco came through with their cost cuts. Cisco shifting into maybe an AI play. That is also something kind of interesting. Walmart today, some very strong earnings that also kind of helped confirm that the consumer isn't dead. But again, I think you look at Walmart. What do you have? You have a retailer that is now adding all these other services, these other things to boost margins. So you have companies that are transforming their businesses. The AI thing is spreading. We're seeing it in Cisco. I saw a tweet from some guy on CNBC, and he basically said that that one of the executives at Walmart said they're using large language models to improve millions, hundreds of millions of pieces of data in their catalog. And he said it's allowing us to do data work that would require 100 times more people. So again, there is the argument that AI is going to fuel improved productivity, improved profitability. And now we have the world's biggest, maybe, I think they're the world's biggest retailer. They're at least the United States' biggest retailer, and I think the United States' largest private sector employer, Walmart. So it's not a small company. And what are they saying? They're saying they're seeing big bucks returns, big benefits from AI. So again, when you look at across this, I think we're seeing that this secular growth story is not dead. Now, if you look down here, there was an article here that was kind of from Reuters and S&P Global. They mentioned that utilities are seeing data, the demand for electricity from AI is boosting significantly the demand for data centers. Now, utility stocks, I think also you got to be careful because strong retail sales, higher interest rates, stronger economy does not make people want to own utilities. But again, it's interesting to kind of see that here's an area where AI, it's driving another part of business, and more electricity demand is going to be some infrastructure associated with that. There'll be some people building more towers and wires and all that stuff, and that turns into orders for the industrial sector. So got to jump over now. We do our market trends on Mondays, and we look at these different as we look at the um, the indexes and XLI. I've got to jump over and show you. In fact, let me just quickly share with you guys. I forgot to do that. I'm going to share this in the chat. I've got some other ideas I got to share with you guys too. I got a lot today. I'm racing because I'm trying to get this done in half an hour now. We're doing half an hour on Monday, half an hour on Thursdays. But look here at the XLI. I shared this some links with you guys. Now we had talked on state of the market on Monday. This is now not this is a different chart. I don't have time to pull it up, but you can see here we were talking about 126 to 120, the range on XLI, and we were saying at the time, this is something that's been it's been standing tall. It has not been pulling back. It's making these higher lows. I mean, it has held the higher lows that it made going back to April. It has this sideways range, a period of consolidation, and now here we might be on track potentially for a breakout of this range. $120 or 126 is not a very big range for something to be in like this for basically a quarter. 4 months almost, XLI has been in this range. And now I think when you see the retail sales number and everything else, this is something I think that is kind of going to be in people's focus. So for me right here, industrials are this kind of quiet thing in the background that there's a real bullish sort of sense a lot of people have had toward them because of the infrastructure build out and the stronger economy. They're just kind of lurking in the background. And here they've been consolidating. And I don't know. I think I want to point this out. We basically had said that industrials were in a spot where this 120 to 126 range was key. And then, a breakout of that might see follow through. And so I think it's interesting because it looks like we might be at a spot where this could actually see that. So industrials here, I think might want to be on our radar as we go into the kind of period of time later in the year when people start to think more about the cyclical economy, XLI, and some of the names associated with that. Okay. Also, don't forget that the home builders, we did a trading view idea in DR Horton, but there's housing data in the morning. Home builders, I think, are just kind of interesting. We saw one of the points that we put here in our rundown was the fact that we saw this big surge in refinancing of mortgages here. Again, this is just something again that is just there in the background that housing. It's just kind of like the forces just keep coming off the bench. you have housing, you have AI, you have industrials, you have financials with the fact that they're seeing better net interest margins. We cited the guy from Truist recently. There was some other people talking about the strength, the fact that S&P Global had noted the fact that we have lower loan loss than expected. We talked about that last week. Financials here. In fact, we have a quick little thing we want to show you about Bank of America, but just all these things are interesting. Then something else that just comes off the bench, it's Apple. I mean, let's remember, expected to be September 10th. We're going to have expected. I mean, this is not yet officially announced or anything of the sort, but Apple is expected to, if you read different people covering Apple, they said September 10th, we could see the new iPhone unveiled and all that. Dan Ives at Wedbush says we're already starting to see an iPhone super cycle developing. There was also a note from Morgan Stanley on something similar here. Morgan Stanley had put out a note as well. They were saying that they're seeing really strong, it was the same thing, channel checks. So they're basically talking to the people who make the iPhones and suppliers and all that stuff, the channel check stuff. So we're seeing it from Wedbush. We're seeing it from Morgan Stanley. Again, these are things all coming off the bench that are still, out there as potential catalysts. So we had kind of mentioned that it's, difficult to really see an abandonment of big cap growth when we still have Nvidia coming, we still have Blackwell coming, we still have iPhone coming, those things out there. And then after that, we have the Fed coming. And then after that, we're going to have, the election coming. And after that, we're going to have, end of year sort of stuff in terms of, seasonality and in terms of, retail and, consumer spending and all that. So when you look out there into the future, it doesn't really like, and this is the main thing we had kind of emphasized in this article, is that, from here, does does the news get better? And I think when you just kind of, we have all these items here. So, check this thing out we do on Monday because we kind of highlight, when you're a reporter like I was for years at Bloomberg and places like that, you have to anticipate, you have to skate to where the puck is. You have to know what the news stories are going to be, or else you don't know what press conference to go to. You don't know what press release to read or who to talk to. So I use these kind of things that I learned from that to kind of help kind of give you guys some, some ideas of things that might be popping up that might be relevant. So I just want to mention that. Now, a few things that really did pop out that I just mentioned in the last, I think it was actually in this last, it was this article, it was 2 articles ago, 2 weeks ago, Mohawk. This to me was just really interesting. Look at this tight range. Company makes flooring, housing related name, right there, kind of, holding above the 21-day exponential. Tight little range here. Housing data tomorrow. This is something just kind of grabbed my attention. Might be kind of interesting. Okay. Let me just make sure I'm not overlooking anything else. Those are the main things. All right. I want to kind of now turn to a few potential things that were jumping up to me in terms of options. Just always kind of looking for some ideas out there. And, to me, Bank of America is kind of interesting because it had this whole kind of I mean, same thing with Apple. It's like, oh no, Warren Buffett sold Apple, blah, and blah, and then it comes back. Same thing with Bank of America, something like that. Strong retail sales, all those sort of things in terms of what they mean for the economy. This was a strong earnings report. If I remember, I'm pretty sure this was the earnings right here on these guys. And so anyway, they had good earnings and then Warren Buffett sold them or whatever. So the question now is, with the Fed, expected to cut, with the economy not in recession and all those things, does Bank of America, work its way back up to say 42 or 43? Because if it does, then let's take a look at the Option Station Pro here. Wait a second. Here we go. Wait a second. My Option Station Pro moved on me. Let me bring it over. There we go. There. All right. Bank of America. Sorry. All right. So a person could take a look here, Bank of America. As you can see, Bank of America will be reporting on roughly October 15th. So a person, thinking for, some kind of continuation maybe of things not being, terrible in a name like this, or, the potential for some kind of positive sort of follow through, might take a look at this. And now you can see that we're looking at the 16th of August, which is tomorrow. We can go out here and expand this to October 18th, which is the October standard sort of monthly options. And stock right now $39. Now look at here, if we click on the 41 on the ask. That tells, potentially a buy, and then hold down the control button and click on the 43. And a person can see from this that a vertical spread in this, buying the 80s and buying the 41s for 80, selling the 43s for 30. That's a net cost of, wait, click on this one first. Now I'm going to hold down control and click on that. It says to sell the 43s. Net cost is, under 50 cents. So if the stock goes to $43 or higher on expiration, that expands to $2 for a cost of less than 50 cents, which is a potential return of over 300%. So this was one that popped out to me as something that, um, you know, um, I'm just looking at something like Bank of America here, and I mean, 43. When you consider the overall environment we're in now, is that an unreasonable, sort of thing? Is that a crazy idea, or is that something that people might say, "Wow, we're not in a recession and everything else"? So, to me, I want to just kind of point that one out. Now, at the same time, I think it's interesting. Amazon here, I think is, I don't know. This is just one that actually no, was it? I was thinking Amazon, and if people, if the market does kind of stall and roll over, I mean, their last earnings were not great. It's like the idea of it being a high valuation, mega cap and things like that. And if people look for any kind of downside or chopping, I did want to just mention that this is one where, if people are thinking now at this moment, in the market being high and everything, but for something to just kind of think about, people might look for a retest of this back under 170. So I was just looking at some potential, opportunities in here. And like, say, for example, the market stalls and we go into dog days of summer and the Fed minutes are kind of hawkish and things get beaten down. People might actually be looking at something like Amazon for the kind of end of month, the August 30th, something like this. People might look at something like the on the put side. These the you basically have the 172 half puts and the 67 half puts, another $5 spread. It's under $1. So again, that's one that is a $5 wide spread, um, for 95 cents for the stock moving down 10 points, potentially, about 400% potentially if it were to go down to that level. So, at this point, I'm not really trying to, say anything overly bearish on anything here, because I do think we're in a spot now where, you have to sometimes, not look a gift horse in the mouth in terms of something that's overly bullish. We are in an environment here. And, I've said it when you look at things that this environment does resemble, the mid to late 90s. We are in a situation where a whole generation of investors is kind of coming of age. They have household formation. They have an inflationary scare and rate hikes, going the other way. They have an economy that's actually showing some real improvement. All these things are coming together, surprising to the upside. And I think right now to really take much of a negative position, I think is kind of ill, and it just doesn't match the reality of what's really occurring right now. And that was the main point I think we wanted to emphasize, in this sort of in our rundown here today, is that essentially we're in a situation where this is abnormal, and I think this is going to become more of a talking point. So what are we doing? What am I watching? Tomorrow, consumer sentiment from University of Michigan. Let's see. And sometimes they talk about politics. Let's see if we start to get the loathing of politics that have been hurting sentiment, because this is part of the numbers. Does that start to actually change? We'll find out tomorrow. I think it's at 10 a.m. Eastern. I don't know exactly the hour of that. Just a few of the points that are kind of interesting here was that FactSet has actually kind of said that that revenues in the S&P 500 were growing in the second quarter the fastest since the end of 2022. Mortgage applications, a big spike in activity. Inflation CPI was under 3% for the first time since early 2021, I think it was. So again, we're at a spot here where PPI was cool, CPI was under 3%. So these are the sort of big numbers that Main Street sees and can actually fit into our kind of the observation we are making here. So those are really the main things I wanted to mention. Don't forget about Fed minutes next week. I've just seen things like that kind of come out of left field and then just suddenly hurt people. So right now, this was in many ways the last of the data points, in my view, that really has the potential to have much of an impact on the overall market. for the rest of the month. But then, of course, we do have the housing data tomorrow. That can impact home builders and nothing else. Consumer sentiment is worth watching, not likely to really have much of an impact overall on equities per se on the market overall. So those are the main things. Remember, Jackson Hole is as good chance it's going to be Friday, but last time I checked, they had not confirmed that yet. So we always want to just kind of put those things out there. We will be back on Monday. Remember, 2 p.m. now on Mondays. Going forward, that will be the time we do State of the Market. It's great to see you guys, and I'll see you next week. Have a great weekend.